If you with it, drop it. If you with it, drop it.
Hey guys, Thea Marcacci here. I am your bestie in real estate, and this is Ace Your Next Move podcast. And I'm so excited to be bringing Nikki Power of Guaranty Mortgage here. She is an amazing loan officer, senior loan officer, and we've got a few scenarios we're going to play out. But I'm going to give Nikki an opportunity to share with you some of her credentials and experience, and then we're going to kind of get into some loan options for a particular property that we are going to go over. So, Nikki, can you give them a little bit of an idea of
thank you.
your experience?
Thank you for having me.
Absolutely.
And for the introduction, my name is Nikki Power. I'm a senior loan officer with Guaranty Mortgage. We're a local lender here in Beaufort, Georgia. I do service all of the state of Georgia and Florida. And one of my expertise that I really love is investment properties and how to help people accomplish that and start building wealth, not only for themselves, but for their future and their family. And so we're going to go through, we've got a specific property in mind in a college area where it'd be a great opportunity for a student parent situation. And I've gotten a comparison with the different loan programs, your Convential, all your kind of options for living in the home and it being an investment property versus just an investment property. And I'm excited to go through all of that with you here today.
Awesome. So I'm going to go ahead and put Nikki's information up here real quick because I wanted to kind of show it to you here. We also have the ability, if you want a copy of this scenario, or if you just want some information about these different scenarios, Nikki can definitely get that information to you. But Nikki, so there's a property in Athens, which is where I now live, and it is a duplex. And so this property, you identified some possibilities here. So the duplex is listed right now at a $337,000, and you did a couple of different scenarios. So let's kind of go through the possibilities of the scenarios.
Yes.
One of the things you mentioned in kind of our introduction there was, like, if I have a student that's going off to UGA or UNG or any college town, they're going to have to pay a dorm fee. Now that first year you might have to, but like thinking about like investment purposes and stuff like that going forward. So let's kind of, can we start off with that? Like if you are a parent and your kid is going to a college, how do you go about possibly building wealth for the future and maybe taking some of that burden of that dorm kind of going out the windows?
To start as a parent in this type of situation, you're already going to have the expense of, like you said, paying their dorm or their rent or whatever it is. So, one great thing about this is there's several things really, but one, you are, setting up, you're not only building your own portfolio of investment opportunities, because that is one positive, right? Even though you're doing this for your kid, building your own, wealth and your own portfolio and your property investment, but also, the rent you'd be paying, the dorm fee is actually towards your mortgage, right? Setting that child up for really setting him up in a great situation to start building credit, to start building their own wealth and experience in investment properties, how to be a landlord, how to be responsible, how to take care of all that. And the ultimate goal is really to, have the rent that they're receiving cover the mortgage if at all possible, which is also great when you're dealing with your kid and in trying to help them learn money and all of these types of things. So it's really a great.
That's fantastic. And I love that. I didn't even know this was a thing is your college age kid can actually purchase that duplex. So this duplex we're talking about could purchase that duplex with the parents' help.
Yes.
They're considered owner occupied, and you can use the rent for the other side of the duplex to help the student become qualified to actually purchase this, again, with parents' help, but parents are not the owner occupied on this, right?
Right, so exactly. That's a very key thing. So as part of this comparison, what I've done is I've done several scenarios. The first one's being the scenario in which you do have your college student on the loan with you. And why that's important is that makes it a primary residence purchase. So even if you as a parent are not going to live in the home, you can still purchase it as a primary residence as long as your college child is on the loan. Why is that important for it to be a primary residence? Because that allows you the smallest down payment requirements. That allows you, a cheaper interest rate.
And so this is an FHA purchase, right?
Yes. So we're going to go through several, but yeah, just kind of explaining that all of these first scenarios I'm going to go through are all with the requirement of the college kid being on the loan.
Right.
So they do have to have something. Now, if they have a 0 credit score, that doesn't mean we can't help them. There's different ways we can go about it, but just to explain, these first scenarios are all with that requirement. Again, this is a really positive thing because it's where you're getting the most cost savings because you're buying it as a primary residence and not straight as an investment property. So does that make sense?
That makes sense.
Well? Okay.
So yeah, because a lot of times what happens when you go buy an investment property, you're going to be putting yourself into a different category.
You are.
Which means that interest rate is going to be much higher.
Much higher interest rate, higher down payment requirements. Right. Exactly.
So you've got, this one is kind of like the best of both of many worlds in the sense that the student is gaining credit. The parent is not having to actually go out and buy it as an investment property, but they can help the student gain wealth over time. And then that money that was going towards the dorm fee is now going towards building that equity in this property over the years.
Which is mutually beneficial because you as the parent, you're building it, and for your child as well. You're in an endeavor together that is setting them up for future wealth. It's really great. It's a wonderful thing if you can do it. So these first few scenarios are going to all be with this situation we discussed of the college student being on the loan, so a primary residence. So option 1, we've got 3 we're going to go through here. So FHA, a conventional, and I did 2 conventionals, which I will explain why, and then the VA. So let's start with FHA. FHA is a loan program that is only for primary residence purchases. You cannot get an FHA loan for just a straight investment property. FHA is a really great program, especially for first-time home buyers, because it does allow a minimum down payment of 3.5%, and it does offer really appealing interest rates as well. So with this first option you're going to see on this list is our FHA. As you can see, we've got the sales price, the $337,000, 6.3 interest rate. We've got the breakdown of monthly payment, which I did pull property tax records on this specific property, so this is accurate. Of course, this is an example property we're using,
this is an example,
but it's a good, leeway here. The homeowner's insurance, the PMI in there. Then it's also got your cash to close breakdown as well of what you'll be looking like as far as down payment and closing costs. The great thing about FHA is no matter if it's 1 unit or 4 units, they still only require 3.5% down. As with a lot of other programs, or when you're talking an investment program, investment property specifically, you're looking at higher down payment requirements depending on how many units there are in the property. So this is a really great option for this property. It is a duplex, it's 2 units, and they're still only having to put 3.5% down. So this means that you yourself could purchase this as your primary, your college student, or if you are a parent of a college student, you could both be on it and both qualify for that. And that's the FHA.
Right. And so on this, the cash close is 23.6. Now, we'll put that disclaimer out there. Every scenario is different, but we did want to kind of come to you with a potential property just to kind of identify what this looks like. So that's 23,600 cash to closing, and that means that your student would have one side of that property, and this is a 4-bedroom, 4-bedroom, 2-bath duplex, meaning 2-1 and one side and 2-1 on the other side. So then what happens is you pay the $2,700 a month for the whole unit. You pay your student's portion, and then the other party pays their portion of it. Right. So now you're building equity over time.
Absolutely.
Awesome.
All right, so then going on to our next 2 options here, conventional, and I did 2 for a specific reason. So the first option is a 3% down. The second is a 5% down. The reason I did this is that if it's more than 1 unit, you have to put 5% down. So it's a little different than the FHA, which just allows you to do 3.5 no matter what. If it's a 2, 3, or 4 unit, you have to put 5% down. So that's one reason why I put that there. So we'll down. This is if one of the people on the loan have to be a first-time home buyer. That is a requirement. So whether that's you or a college student or whatever that is,
Right.
to get 3%, you'd have to be a first-time home buyer. Now, what is a first-time home buyer, Thea?
I believe it means you haven't owned or purchased a home in the last 3 years.
That is exactly
Ding,
right.
Ding, ding, ding.
Exactly. Knew you knew the answer to that. So 3 years, that's right. So even if you bought a home 5 years ago and sold it, you're still qualified as first-time home buyer again. So that's our first option here with the 3% down. And as you can see, I mean, we're looking $21,000, assuming the seller pays nothing towards your closing costs of out of pocket.
Well, and I mean, this is all assuming that you're going to pay the list price. This is all assuming you're not going to get any assistance. But this is like, I guess, what the worst case scenario is.
Yeah, I did high estimations to try and just make sure that it's a very realistic if you're looking at this. So, so that's our 3% option. Then we're going to our 5. Now, again, that's if there's more than one unit. Or if there's no one on the loan that is a first-time home buyer, we'd have to do this 5% down. As you can see, still very reasonable as far as your monthly payment and everything. Your PMI is a little bit less because you're putting a little bit more down. Still great options here. Questions on any of the conventional
No, I think that's great. So, I mean, I guess they're the 3% conventional. So I would think that would be more of someone who is just maybe moving into that area, just happens to be maybe in a college area, or maybe it isn't. And they're a first-time home buyer, and now they want to potentially create wealth in the sense that they're going to come in, they're only going to have to put 3% down. Yeah. They're going to have a great interest rate and about $22,000 to close. And then they have somebody else helping to pay their mortgage basically on that. So the other part of that is on the 5%, then you've got, and again, similar to the FHA one, you've got some options there. You have to put more down. That's the big part of that one, right? So I guess it just depends on what looks best for you. I guess let me ask you this, and this is just one of those things about the different types of loans. So on that 5% option, that's a conventional loan. On an FHA loan, you have that 1.75%, mortgage, what is that funding fee, I think it is, right?
Upfront PMI. So
you're paying that, you're building that into the loan. You don't have to do that on the conventional side. Right. So is that kind of where, just have to really look at the numbers to see what makes sense
exactly.
to you?
And that's why we always look at both. So if you'll look at, you see there's a line that says base loan amount on here and a line that says total loan amount. As you can see with the conventional, they're equivalent. But with the base and the total, that's got that exact upfront in there. That goes into there. Now, is that something that makes or breaks whether you do conventional or FHA? Yeah, it's definitely a factor. Right. Along with the PMI, as you can see, the PMI is a lot cheaper with the conventional than it is with so a lot of that's going to really depend on your credit score. So usually as a lender, when we're looking at someone who qualifies for both the FHA and conventional, we're really looking at their specifics. Right. So if they've got a lower credit score, then FHA is almost always going to be a better bet, even with that added 1.75 in there. It really just depends on your situation. Exactly.
Well, and I mean, we're talking about the least amount of money to bring to the table, but if somebody did want to bring more money to the table in either of these scenarios, like that mortgage insurance never goes away on an FHA loan product, right? So that is something that as you hit that 20% threshold on this purchase or any home purchase, you can have that eventually removed if you with your lender, and so you're not having to pay that going into the future. So there's different things to look at as far as what you're bringing to the table, as far as the long term for a particular loan product.
Absolutely.
So that's great. These are awesome scenarios, giving you kind of an idea of what this is. So I see
it really helps when you're looking at it side by side. There's just something about that. I love giving customers this because they can see it themselves and really look at one option versus another and the monthly payment, the cost, etc. So
and then we talked about like the VA loan. I love the VA loans. I love being able to help veterans and stuff like that. So let's kind of identify the
so the VA is the fourth option on here, in which it again would have to be a primary residence. A VA loan, one of the best loan programs that exist as far as cost savings. They allow you to put 0% down. They have no PMI. So really, if you qualify for a VA loan, it's almost always your best bet to go with that. Right. We still look, but it's definitely a great option. So with this VA, you can see now the great thing about VA also is no matter if it's 1 unit or 4 units, you still don't have to put a down payment. How amazing is that?
Yeah, it's amazing.
So no matter if it's 1 or 4, I'll say that again, you don't have to you can still do 0% down. Of course, this is all contingent on your certificate of eligibility for what you qualify for VA benefits. But generally speaking, the guidelines, 0% down no matter what, and no PMI no matter what. So this is a really great option. The thing to remember on a VA loan is that you can't have a cosigner, a parent or someone on the loan with you. VA does restrict you to only husband and wife. So it can't be a parent and a child. It can't be a brother and a sister. If there's more than one person on the loan, it has to be married. You have to be a married spouse. That's the one thing on this that is to consider, if you do qualify for VA.
Right. So basically your cash to closing on that is like half of the other options because you're not having to put that down payment down. Exactly. So you've got just about $12,000 into purchasing this. Again, so now let me ask you this. So it is owner occupied, but they can rent out the other side still, even though it's owner occupied. So because they're living in the one side and they can rent out the other side. So now they have that option of basically, again, creating wealth for themselves over time. Now, let me ask you this. So what happens if, down the line that this VA owner occupied, what if they want to move? Maybe they want to move out. Do they have options? Like if they move a year or so down the line, do they have options with that duplex? I mean, what happens with their loan and their benefits and stuff like that?
Yes, that is a question I get a lot in regards to VA loans. It's kind of a myth that a lot of people think you can't have more than one VA loan at a time. While that can be true, it all depends on your eligibility.
Right.
And how much you have left in your entitlement. So you could very well purchase this, let's say you're purchase a quadplex as a primary residence, pay $12,000, in this scenario,
right?
Start, earning that income where you're renting out the other 3. All of that is completely within the guidelines of the loan program. All that's allowed. And at some point, maybe you then buy a different primary residence, still using your VA loan, your VA entitlement, depending if you still have eligibility left.
Now like on this particular one, you buy this duplex, and a year later or whatever, are you able to move out of it and then purchase another primary?
Yes,
so I thought that was the case. So is it like a year, or how long is that?
Yes. So a thing that gets really confusing, right?
Okay.
One of the many things with mortgages that gets really confusing is that a VA loan can only be used for a primary purchase home. So kind of like FHA, like we previously talked about, you can only use it for a primary residence. So sometimes people get confused. Well, it's also rented out, but no, it was bought as a primary residence that you're living in one of those units. So that's how it was bought. Then if you wanted to move out and use your VA loan again for another primary, you couldn't use your VA for a straight investment property where you kept living in this one, right? You could use it for the purchase of another primary residence. It's okay that this one is now an investment property, because that wasn't your intentions at the time of purchase. The intentions at time of purchase was you were going to live in one of the units, you moved into one of the units, and then however long down the line you decide you want to turn your own unit into another rental and then go get you a single family home yourself for your primary residence. And that you can do. It's all, again, depends on your VA entitlement amount. So it's not just a flat, everyone who qualifies for VA can do it, but it is possible and it is allowed.
And so someone who has VA benefits, definitely checking in on what those benefits are will help you determine whether or not, this is a scenario. But, anybody who leaves, what is it, is a DD 214, I think it is, or something like that. If you, your certificate of eligibility, there are just some amazing options. I mean, you can see here, $11,970, and you can be into a duplex, and it is pretty amazing.
Or quadplex.
Or quadplex, up to four. So, finding them can be challenging.
Yes, of course.
And that's where, that is where moving into or looking in an area where you're talking about like schools and colleges and that kind of stuff, you're going to potentially find more options for that kind of living in those kind of areas. So I know this particular scenario happens to be in Athens, about a mile from UGA. I know there's a bunch of options over like at Kennesaw and by
because there's a lot of demand
UNG and stuff like that. So there's demand, and where there's demand, there's going to be that. Now, a full-on
Yes.
investment
So,
property.
yes,
This is
let's
if
talk
you are
about
an
that one.
investor, the DSCR loan. So what exactly is a DSCR loan?
Yeah, so let's definitely dive into that. Well, first, I do want to say the main thing to take away from these first four we were looking at and make sure that this is setting in is this allows you to buy an investment property.
Yeah.
Without having to have the interest rate, the down payment, et cetera. So that's what's really key in what we're talking about here is being able to have your own first home, you're not your first, but owner-occupant, the home that you live in yourself, but also becoming an investor, becoming a landlord, and using loan programs that are available like this to help you accomplish that without having bukus of money and perfect credit and all that. So anyway, segueing into the DSCR loan. Now, DSCR, a lot of people don't know what that means. You don't really have to know what this stands for, because even if you did, it's not going to make any sense. Debt service coverage ratio, which gibberish.
Okay, so debt service coverage ratio. So let's
you'll never remember what that means.
Vanna White, let's open up the door. What is this?
So what this program is, it is for investment properties only. So this is not if you're buying a primary residence. This is a straight investment property. It could be a short-term rental or a long-term rental. What this is it is a loan program that we are qualifying you based off the expected projected income of the subject property.
And that's what the debt service is, right? Like that's the service part of it.
Yep, exactly.
You're servicing the loan with the potential rent, right?
Yep, exactly. So with that program, we're looking at your credit, we're looking at your assets, we're looking at the income that's expected to be produced from that subject property. So that means we're not calculating your income. We're not verifying your employment, getting pay stubs, getting tax returns. We're not doing any of that. We're not verifying your employment at all. We're not even confirming if you are employed. What we are doing is we are, like I said, looking at credit is a big one. So credit's a big thing. We're looking at assets, having the funds available to be able to not only put the down payment and pay closing costs, but also reserves. Now, Thea, can you explain what reserves are?
Well, that's like for your taxes and all that kind of stuff, right? You want to make sure you can service the rest of it, not just the loan part, but also like you pay your taxes and all that kind of stuff.
Right. So being able to have
mortgage or insurance,
your mortgage payment. So so a reserve is let's say you need 3 months reserves. That means you need 3 months mortgage payment worth of your mortgage payment in your bank account after the closing of the home. So all in assets of what we're looking at. And then of course, what the, subject property income is going to be. How we do that is we do an appraisal report with what's called a rent schedule, where we're looking at rent market analysis rent. And then there's a percentage where that ratio word comes into play that we're calculating to determine, whether the property is eligible. So of course, this means that your projected rent would have to be at least, typically what your mortgage payment is. There's of course a lot of different exceptions and requirements for, condos, or if you're a first time investor or whatever, but there's been a lot more leniencies with this program. We've opened up a lot of, making it available to short-term rentals now. So your Airbnb and VRBO, also it being available to first-time investors as well. It used to only be a program, specifically for experienced investors. Now we can do it for first-time investors. All really great. And then also we made severe, really serious improvements to where the rates are, an investment property interest rate's always going to be higher than a primary.
Usually it used to be about 2%, right? Or more.
And this one, as you can see, it's 1.
Yeah, which is great.
And this is even with 15% down, which is the minimum. As you notice, there's still no PMI because there's no PMI on this product.
Well, and the amazing thing is, that 15% down is also another amazing thing, because usually I've heard in the past it's like 25% down.
Yeah, it's more recent that we've opened up the 15. You do have to have a credit score of over 720 or 740, I believe. So you do have to have other things.
So is that with the 15% down, or in general, or is it if you put more down, you'd have more flexibility with the credit score, or is it?
The 15% is the credit,
the best credit score, the best credit scenario. Okay, so if you have good credit, really good credit, solid credit, A+ credit, you can go in with 1% over your normal rates, which is your, and with a 15% down, which is pretty phenomenal when you consider your bank. And you're not like looking at your taxes. You're not looking at your you might not even be employed. I mean, that's amazing. It's just because the debt service of it is that projected rent.
Exactly.
That's amazing.
Yeah. So we're not calculating debt ratio either. So when we're not looking at your income, we're not looking at what your monthly debts are either. So, and then of course, if you put more than 15, the more down payment you put on an investment property, typically the lower the rate.
Right.
So, if you're putting 30% down, your rate might not even be as bad. So, but I gave the option of the 15% down here, since that is the minimum required.
Sure.
To compare with the other programs. So how did I do with explaining
this? This is
DSCR?
amazing. I love it. One of the things is, and I'm going to come back over here to us being on this screen. Oop, the wrong one. Here we go. So, what we wanted to do today is, part of this, my Ace Your Next Move podcast is to bring into the equation. There are people out there who do want investment properties. They do want options. Maybe they do want to build wealth. And I wanted to make sure that we shared with you in a way that kind of went across the platform. We've got FHA represented here. We've got conventional loan represented here. We've got a VA loan represented here. And we've got a DSCR investor loan represented here. And this is all on the same property. Yep. So there's lots of different options here. And that's why I love having Nikki come and share this with you, because she has a breadth of knowledge in all of these different areas. And she loves to be able to get in here and dig down and figure out what might be the best option for you. So whether you are a first-time home buyer, or whether you are potentially, a parent or a parent with a student that wants to maybe invest rather than just put that out there and pay a dorm fee. And maybe even that first year, you might have to pay that freshman year dorm fee, but thinking about what the next year's options might be. So it just kind of put that into your mind as an option going forward. And then if you are just someone out there that is potentially going to purchase in an area that is close to a college, or it might be a wealth building exercise for you to consider maybe buying a property that would allow you to have someone else pay your mortgage and build that equity over
Anytime
time.
you can have someone else pay your mortgage, you do it, right?
It is fantastic. So thank you so much, Nikki. I appreciate
My
you
pleasure.
so much for bringing this information to you about this property. If you have any questions for Nikki or myself, please feel free to reach out and let us know. This is Thea Marcacci with Nikki Power here at Guaranty Mortgage, and this is Ace Your Next Move podcast, and we'd love to talk a little bit more with you about any of your options that you have. Feel free to reach out to us, and then we'll put our information below. Thank you, guys.
Thank you.
Bye. Thank you so much for stopping by Ace Your Next Move podcast. We're so glad you're here. Please feel free to check out our next episode at aceyournextmove.com.